Celsius stock dropped 25% after they announced their earnings. It's trading at $45 at the time of this recording with a market cap of $11.6 billion. In this video, I'm going to talk about whether $45 stock price is a good cost basis to start a position in Celsius or to dollar cost average. Before I continue, I'm just going to ask if you can smash that like button, subscribe to the channel, and let's continue growing together. I just want to clarify that this is not financial advice. I'm simply recording my thoughts about Celsius. I'm not qualified to give financial advice. In full disclosure, I do own 200 shares at $22 each, and I sold the call at $22 for 30% gain. Now, before we did few videos on Celsius, we started covering it at $52. And in that particular video, we said it is a buy at $52. Ever since the stock went to $90, just to go back to early 20s. When it went to early 20s, we did a video saying it's a great time to dollar cost average. A lot of our friends and subscribers did DCA at that time. And from the polls I conducted, most of them had a cost basis in the 30s and 40s. Let us first look at the main reason why the stock dropped. Celsius shares fell over 25% despite beating third quarter revenue and EPS estimates. The sell-off was driven by a $247 million distributor termination charge tied to shifting Allen & New distribution to Pepsi, which resulted in a GAAP net loss of $61 million. This has also resulted in a negative 11% operating margin, which we can consider as a temporary issue. Celsius is still integrating its acquisitions, so this is expected. Now, the company brand retail sales grew only 13% year over year, and US market share slipped by 0.5 points, signaling possible saturation. Most growth came from Allen & New rather than the organic Celsius performance. Rising long-term debt and inventory adjustments during Pepsi transition added uncertainty. Now investors focused on structural concerns and pressure in making profits rather than headline revenue growth. Let us now look at the numbers for 2025. The full year revenue is estimated at $2.46 billion. Full year EPS is at 81 cents, with 2026 projected at $1.10. Gross margin is expected to stay at 50%. Growth drivers include Pepsi distribution expansion, Allen & New integration, and Rockstar acquisition. I will show you now the valuation for 2030. Current revenue is at $2.4 billion with the growth drivers that I just mentioned previously. I estimated $4.5 billion in revenue by 2030, and I think this is reasonable as their competitors are making over $10 billion in revenue currently. Based on 50% gross margin with supply chain efficiencies built in, they can get to 20% net margin. I did assume dilution to 260 million shares. I assume 30 multiple, which puts them at $103 by 2030. This is 131% gain from the current price of $45. Now, that is a concern, but I think they can handle it with their profit. Personally, I am a buyer of Celsius at $45, and I may add in the coming days. What do you guys think? Let me know your thoughts in the comments, and thank you so much for watching.